SoFi stock is up almost 100% over the past year due to rapid increases in revenue growth and turning profitable over the past year. SoFi operates as a direct bank to customers and also other institutions using their premium technology. SoFi had its IPO in 2020 and has only been public for almost 5 years. SoFi has still not got back to its IPO price and is at about $15. However, it was trading near $5 just a year ago. So today in this video, I'm going to determine if we should buy SoFi stock using my 7-step stock analysis. The first metric that I like to look at for a company using my 7-step stock analysis is the PE ratio. I want the PE ratio to be greater than 0. This means that the company is making a profit and isn't losing money every year. As we can see with SoFi, only right now have they become profitable. Over the past years, they have been negative net income, but over this past year, they have made money, so that is a good thing. And as we can see here, the trailing PE ratio is 37.95. So that is greater than 0, showing that they are profitable now, so that is a check mark. The next metric that I like to look at is the forward PE ratio. The forward PE ratio, I want this to be less than 30. If we look at the forward PE ratio, it allows us to see how much we are spending for the future earnings of the company. Say the forward PE ratio is 20, that means we are spending $20 for $1 of future net income of the company. So we want this to be less than 30. But as we can see here for SoFi, they have a forward PE ratio of 51.02, which is greater than 30, and that is an X for SoFi. And could show that SoFi is a bit overvalued, but we do not know yet until we do the intrinsic value calculator. Now I'm going to look at the revenue growth of SoFi. I want the revenue growth rate to be growing at a greater than 5% rate year over year to show that the company's sales are growing over time. As we can see with SoFi, this looks very good. It's all green, and as of late, it has been slowing down, but it is still growing at an about 30% rate, which is very much higher than what we want. So this is a check mark, and it looks very good for SoFi's revenue growth, showing that their sales have been increasing pretty fast. So this is pretty good. Then I like to look at the EPS growth rate. I want the EPS growth rate to be greater than 5%. As we can see with SoFi, it is pretty much all over the place, but as of recent, they have turned to positive territory for EPS. So it is looking pretty good, but the growth rate is there, but it's technically not possible to calculate the growth rate from negative to positive. As we can see in 2023, it has been around negative 50 cents, but now it's at 12 cents. So it has been growing pretty good, and if it continues at this rate, I think this is good for SoFi. I'm going to give this a check mark. Now I'm going to look at the shares outstanding of a company. We want the shares outstanding to be decreasing over time. As we can see with SoFi, the shares outstanding have been increasing over time, which means SoFi is diluting shareholders. However, it might be a good move if the shares are very overvalued, but nonetheless it is still an X. Now I like to look at the debt of the company compared to the equity, which is the debt divided by equity. I want this to be less than 100%. If it is less than 100%, that means they have more equity than debt. So we do not want a company to have more debt than equity. As we can see here, SoFi has a 54.39% debt to equity ratio, which is a check mark and shows that SoFi has almost double the amount of equity as they do debt. So that looks pretty good for SoFi. While it is not amazing, it still looks pretty good and is pretty unlikely for SoFi to go bankrupt. And now the final thing that I like to look at is the analyst expectations of future growth. I want the future EPS growth to be greater than 5% by analysts. As we can see here, analysts expect SoFi to grow at an 18.5% rate, which is over triple of what we want. So this is very good for SoFi and shows that we should probably pay a premium for the stock. Now we are at the most important part of the video where I'm going to calculate the intrinsic value of SoFi stock. When you calculate an intrinsic value, you have to use assumptions for the next 10 years. As we can see here, the first assumption we have to make is revenue growth rate. As we can see over here, analysts expect SoFi to grow at a 13.7% rate. So for my assumption, I'm going to put this down to 13% to be a little safe. Now I have to assume the net profit margin over the next 10 years. Over the past 10 years, SoFi's net profit margin has been in the negatives. However, as of late, it has been at 9% in the past 1 year. So I'm going to put the net profit margin at 15% because I do think SoFi could grow their net profit margin all the way up to there, especially because it is more of a technology-based bank. So I'm going to put the net profit margin right at 15%. Cash conversion rate we can leave at 100%. And now the PE ratio. For the PE ratio, I'm going to put it at 25 because SoFi is growing faster than the S&P 500 and I think it deserves a premium. Now I'm going to leave the discount rate at 12% to ensure a margin of safety when we buy these individual stocks. We really want a margin of safety compared to the stock market because we are risking a lot more with just buying one individual company. As we can see here, I have a fair value price for SoFi at $12.92. Right now it's at $15. So if you bought this today, I think you'd make about a 10% return if you do believe these assumptions for the next 10 years. Thank you guys for watching this video. Recommend some more stocks that you want me to analyze, and yeah, see ya.